In this video, I'll be talking about monetary policy and the effect of elasticity of demand for money. So, a quick monetary policy refresher. Monetary policy refers to the actions made by the central bank to manage the money supply. The central bank is the institution responsible for managing the nation's money supply and coordinating the banking system. The central bank in the United States is the Federal Reserve, sometimes called the Fed. Types of monetary policy. Contractionary monetary policy is when the money supply is decreased in an effort to lower the aggregate demand. Expansionary monetary policy is when the money supply is increased in an effort to raise the aggregate demand. The elasticity of demand for money and the effect on monetary policy. The effectiveness of a monetary policy differs based on the elasticity of demand for money. When the demand for money is elastic, changes in the supply of money have a little effect on the interest rate and thus have a little result on the aggregate demand curve as well. When the demand for money is inelastic, monetary policy is allowed to be efficient in impacting the interest rate and subsequently the aggregate demand curve as well. The liquidity trap. The liquidity trap is a situation in which the interest rate is close to zero. When a liquidity trap occurs, the central bank, the Fed, cannot lower interest rates because interest rates cannot go below zero. In a liquidity trap, expansionary monetary policy, like lowering the interest rate, is not effective, since the interest rate cannot go below zero. The liquidity trap was seen during the financial crisis of 2008 when the Fed cut interest rates until they were close to zero, leaving expansionary monetary policy tools ineffective. Challenges of monetary policy. The Federal Reserve faces imperfect information and time lags as the impacts of monetary policy can take months to be seen. Monetary policies implemented at the wrong time by the Federal Reserve can make economic conditions worse. Advantages of monetary policy. The Federal Reserve does not have to wait for politicians to debate and reach a policy consensus, meaning monetary policy often takes less time to enact than fiscal policy does. The Federal Reserve is composed of the most prominent economic policymakers and houses the most extensive economic knowledge in the world.